In this video, I'll be discussing the most recent data on the Federal Reserve's quantitative tightening. If you're an investor and planning to hold stocks for the long term, there's no need to be overly concerned about the potential volatility caused by the Fed's monetary policies. Lately, the Fed has been ramping up quantitative tightening, along with higher interest rates in order to fight inflation. Additionally, I'll be providing regular updates on our current economic situation, and a more detailed video on the Fed's pivot will be coming soon. If you're new to the channel, I encourage you to subscribe, as I'll keep you updated on the latest developments in our economy. The Federal Reserve is actively taking measures to address inflation, and one of its strategies is raising interest rates while reducing its balance sheet, a process known as quantitative tightening. At present, core inflation is recorded at 4.8%, and headline inflation is at 3%. Understanding these two key terms is essential. When the Fed injects money into the economy, it's called quantitative easing. On the other hand, when the Fed withdraws money from the economy, it's referred to as quantitative tightening. I'll be providing regular updates on the Fed's actions, and in this video, I'll present the data from the past few months. This information is available publicly on the Federal Reserve's website, and if you're interested in data from previous months, you can check their website. In the first week of June, the Federal Reserve removed $2.9 billion from the economy. During the second week, the amount withdrawn was $2.1 billion. Moving on to the third week, the Fed removed a significant $19.9 billion, and in the fourth week, the figure stood at $16.4 billion. Overall, for the entire month of June, the Federal Reserve removed a total of $41.3 billion. This amount is notably lower when compared to the previous months. For instance, in May, the Fed withdrew $120.9 billion, and in April, it withdrew $82.3 billion. Thus, it's evident that the Fed's pace has slowed down during June. Looking ahead to July, on July 5th, the Federal Reserve removed $38.9 billion. On July 12th, the withdrawal amounted to $2.3 billion. On July 19th, the Fed removed $20.5 billion. As of now, July is not yet over, but the Federal Reserve has already withdrawn a total of $61.7 billion. Let me share a quick backstory with you. In 2020, due to lockdowns, soaring unemployment, and a 3.5% drop in GDP, a large amount of money was printed to stimulate the economy, causing a rally in the stock market. The injection of trillions of dollars into the economy resulted in inflation, and currently, we are experiencing high inflation levels. To combat this inflation, the Federal Reserve is attempting to reverse the process by withdrawing money from the economy. As they started this process, the stock market has been experiencing a downturn. For investors, it's crucial to understand that you don't fight the Fed. When they inject money into the economy, the stock market tends to rise, and when they withdraw it, the market typically declines. Additionally, the Federal Reserve is raising interest rates, with the current rate standing at 5.25% after a 0.25% increase during their FOMC meeting on May 3rd. While it's uncertain if this will be the last rate hike during this economic cycle, the Fed has paused interest rates during the last FOMC meeting, but they've indicated the possibility of raising rates at least 2 more times. Investors should be aware that the stock market may react unfavorably to these rate hikes, and it's anticipated that the situation could become challenging. The Fed cannot keep interest rates at their current levels for an extended period. If the rates remain unchanged for too long, it could result in reduced corporate profits and negatively impact the economy, leading to a reflection in the lower GDP, which will add pressure on the stock market. As a result, the upcoming Q2 and Q3 numbers is very important. The Q2 GDP numbers will be released on July 27th. I will update you once the data is out. The GDP is experiencing a rapid decline, and Jerome Powell's remarks during the recently released Fed minutes have indicated that the GDP will deteriorate in both Q2 and Q3. Although we are still in positive territory, there's a possibility that the Q2 GDP, to be reported in a few more days, might show negative growth. I don't mean to sound negative or alarm you, but it's essential to stay well informed about the current economic situation. In Q1, the GDP was at 1.1%, falling well below the estimates. This decline was notable, considering it had dropped from 2.6% in the previous quarter and 3.2% before that. Over the past 6 decades, whenever the Federal Reserve has paused interest rate hikes, the stock market has, on average, experienced a 6% increase within 2 to 3 months. Conversely, historical data reveals that during economic cycles, when the Fed opted to cut interest rates, the stock market encountered new lows in 7 out of 9 instances. On average, the stock market has seen a decline of 23% during these periods. However, it's worth noting that 2 exceptions occurred in 1989 in 1995 when the stock market didn't fall. In both cases, inflation levels were around the 2 to 3% range. When facing high inflation, the Federal Reserve may find it necessary to maintain higher interest rates for an extended duration, potentially slowing down economic growth, causing corporate profits to decrease, and exerting downward pressure on the stock market. A significant stock market trend has been observed when the Federal Reserve pivots and starts cutting interest rates. On average, following the final rate hike, the stock market has declined by approximately 23% in 7 out of 9 instances. It's important to remember that the data we discussed earlier are averages, and the stock market's actual performance may differ from expectations. Out of 9 instances, the stock market fell 7 times when the Federal Reserve pivots and began cutting interest rates. The only exceptions were in 1989 and 1995 when inflation was low and the economy was thriving. Therefore, it's more probable that the stock market will experience a decline when the Federal Reserve pivots. Our current economic landscape differs from that of 1989 and 1995, with a downward trend in GDP and inflation above 3%. One can gauge forward sentiments by examining the yield curves, which were normal in the past but are currently inverted. Looking ahead to the upcoming FOMC meeting, there is uncertainty regarding whether the Federal Reserve will pause or continue raising interest rates. Over the last 14 months, the Federal Reserve has raised interest rates 10 times, totaling 5%, and the current Fed funds rate stands at 5.25%. The upcoming Federal Reserve FOMC meeting is scheduled for July 2026, and the question remains whether they will maintain interest rates at 5.25% or hike again by a quarter point to reach 5.5%. Recently, when Powell spoke at the Fed conference, he indicated that they are increasing interest rates. If you're an investor, please be patient. Eventually, easy monetary policies will return. The Fed cannot sustain a high interest rate environment for an extended period. They will eventually need to reduce interest rates and resume money printing. The problem lies not only in the stock market, but also in the debt market. The 10-year yield curve, for instance, is inverted. As interest rates rise, the Fed incurs more interest on the debt, and they too have a budget to adhere to. Cryptocurrencies are likely to react faster than stocks. When the Fed pivots, reducing interest rates and restarting money printing, the stock market and crypto market are likely to skyrocket. However, this will come with a trade-off, leading to more inflation, possibly exceeding current levels. The government will benefit from increased tax revenue due to these changes. In 2020 and 2021, tax revenue soared from capital gains. The Fed, too, requires money due to high interest rates. For financial and political reasons, they will have no choice but to resume money printing. Deflationary environments are challenging for the Fed as they need inflation to manage the old debt. This prediction is based on available data, and when the Fed turns the money printers back on, they will likely announce it. It's essential to pay attention to monthly CPI, PCE reports, and FOMC meetings to form your own opinion and not follow anyone blindly. Keep track of quantitative tightening by checking the Federal Reserve website to see how much money they have been removing from the economy and how the market has reacted. Additionally, monitor the 10-year yield curve, as higher yields often correspond to negative stock market reactions. Also, pay attention to the reverse repo market, available on the Federal Reserve's website. Utilize these publicly available data points to your advantage. When the Fed starts to print money, it will likely happen in 2 phases. The first phase involves the Fed stopping interest rate hikes and quantitative tightening, while the second phase is the actual money printing. However, if a liquidity crisis occurs in the debt market, the Fed may restart the money printers directly, although this scenario is unlikely due to the potential for a severe financial crisis. Thanks for watching. Until next time.